We're going to be talking about the UK stocks that I'm buying right now. We're also going to be talking about the S&P 500 and how it's nearly reached its lows after 50 years, or the fastest decline in the first half of the year. We're also going to be talking about online retailers and typically really retailers in general and how they're dealing with online returns, and how we've also got some competition elsewhere, which links into the comment of the week. And if you like this video, please one of these to help beat that YouTube algorithm. It is much appreciated. So the first thing on the agenda today is the S&P on course to post the first worst half since 1970. A headline like this should immediately be a good signal. You're seeing this is a positive headline. You're going, why is this positive? Why? It doesn't make sense. Because it's so extremely negative that, let's say that it's not had a first worst half since 52 years ago, this surely indicates that, well, if the market works in cycles, then this could be a fantastic opportunity to be alive or be present in the markets at the moment. But no, I guarantee so many of you will be whining in the comments going, oh, all of this, recession, oh, I'm upset, I'm just going to hold cash. Why? Why would you do that? That's ridiculous. Now, in this situation, it's saying, yeah, look, all of it's dropped down a bit. We're in deep negative territory. Again, I see this as a positive sign. If the markets are down, it's a good time to be greedy. Be fearful when others are greedy and greedy when others are fearful. It does seem like people are being quite fearful at the moment, but share prices won't say this alone. Just go have a look at sentiment. Me, overall, I've had so much negativity on Boohoo in the last week. It's been ridiculous just because it has dropped a little bit more in percentage price. People see their stocks drop down in price and they start crying about it online. I get it. Look, if you haven't held a stock before and you're not used to the volatility, fine, that's acceptable. But when you flip your whole agenda or your whole viewpoint based on a falling share price, that's where you begin to realize, okay, this person hasn't actually done their research. What they've done is they've seen their stock price drop and now they're justifying why it's dropped, rather than beforehand doing the research, expecting what may happen and saying, well, this is just random volatility. These people think that they're very intelligent by going, oh, this is why. They're just trying to justify why they've got a falling stock or why they've sold. Who cares? Fuck your agenda. I'm not interested. Regardless, I digress. Now, in this, we've got the 52 years the S&P hasn't had this bad of a first half. And it goes into play further on here, because it says that the S&P 500 is on track to end the first half of the year with the biggest percentage drop since 1970. 1970, that's quite a chunk of time. And they've also said that the Nasdaq was set for its largest decline ever during that same period. So that is obviously a very negative line there. You're saying the stock market, the US, the top companies in the US are on their worst decline since 1970. That right there should be a bullish signal, and I'm seeing it as so. Sure, there might be fears over recession. Sure, we might be going into a cost of living crisis. Well, actually, let's look at this article by KPMG. Now, this is on Hargreaves Lansdown Sharecast. I've spoken about this quite a few times before. Some would even say I've got a positive agenda with them and I'm promoting them because they remain very neutral. Now, they've said here that the UK faces a potential recession, and this was warned. And they've said that the number of domestic and global headwinds and its risks were now skewed to the downside based on the UK economic outlook by KPMG, one of the big four auditors. They've argued that a sharper deterioration in external environment causing a recession in some of the UK's major trading partners, coupled with a stronger fall in consumer spending in the UK, could see the UK economy entering a mild recession next year. You've read that, guys. A mild recession. Now, there are other economies that are significantly struggling. Perhaps those that are very heavily based on commodities now are seeing that the commodity values are falling, and obviously now they're not going to be getting as good of a price. People are cutting back on those expenses, and perhaps even rather than importing goods into their country, they're doing a lot more exports in that regard, or they're just, they're buying domestically, meaning that they're not interested in what's going on abroad. And those that have weaker overall economies or weaker aggregate demand, meaning the total level of spending in a year, those countries that don't have that much being produced in terms of value are obviously going to struggle quite a lot. Now, the UK economy is primarily based upon services. So the UK, actually, whilst it's not typically a fast grower at all, coming out of the pandemic, it's been put in quite a strong situation. Now, they had underperformed quite significantly during the pandemic, as far as I remember, because who was buying their services when everything was shut down? But now that it's reopened, it's in a cost of living crisis on the way. Yes, some of the other major economies are struggling, but at the end of the day, they're still going to need their accounting done. They're still going to need those financials. They're still going to need a lot of these services provided, so they're not just going to throw that away. That coupled with a lot of savings that each of the consumers have, that people have just saved over the last 2 years from the pandemic, it means that actually, if you go have a walk about, you go into some of the restaurants, some of the pubs, they seem to be booming in my opinion. Now, my view could be skewed here because I live in a very affluent town. I fucking hate it, to be honest with you, but I'm here anyway, and I will get out of it where I can. And in this situation, it's very, very positive. But I've travelled a fair bit, and I've travelled about 20 to 30 miles within this sort of radius, and I've seen the same sort of trends. So it does certainly seem that people are still spending, and perhaps this money will run out, which means that mild recession is coming next year. But I figure that was of interest. And they mention here that manufacturing and financial services are amongst the worst affected sectors. And they expect GDP growth to more than half this year to 3.2%, still growing, before slowing to 0.7% in 2023. Again, still growing. Now, to qualify as a recession, correct me if I'm wrong here, because it's either 2 consecutive quarters of negative GDP growth. If that means less than the year before, okay, but in this situation, it seems like it's still growing. So if it's 2 consecutive quarters of negative GDP growth, we would have to see a decline in our GDP. Now, I could have confirmed this, I didn't, so if I'm wrong, tell me. But if that's the case, it doesn't even seem like we're entering a recession at this rate, but it certainly seems that fears are priced that way, another reason that it could be a good time to buy. Now, a comment of the week by BMBM365 has said that it would be good if you covered how retailers are coping with expensive return rates. Now, I've got a fantastic article I'm about to break down with you, and then we're going to talk about the UK stocks that I'm buying right now. So he said that Primark are targeting click and collect. This is actually a very clever strategy. So Primark targeting the likes of click and collect means that they're able to navigate around these concerns with returns. Now, they're only doing it in the northwestern areas. I think it's about 25 sites that they're doing it, but they have the infrastructure because they have the retail outlets and stores for this. This wouldn't work for an online brand because something that is exclusively online, aside from the one shop in Manchester, Boohoo, they don't have retail sites. They don't have places people can go in and try on the goods and then decide if they want it. But in the case of Primark, it can work very well. They order what they want online. They can go into store, they can try it on, and at least then, well, they haven't got to worry about the returns and shipping process because, quite frankly, they'll just stock it in that store. But at the same time, like if you're getting click and collect with Primark, it's very unlikely that they're not going to stock the good that you want anyway. Don't get me wrong, it's like Primark typically has the same batch of goods. They're not really going to have an excessive amount more online, in my opinion. So therefore, I don't really think there's much of a reason or a demand for customers to want to use that click and collect service. But let's see how that performs over time. Now, he also says that how some online retailers are doing free returns, but only in store. This is a clever method, but again, it saves that logistics. It tells the customer, okay, look, you've got to go back into store to get these returns. Again, this works fantastically. And actually, this is where Primark could dominate. They could certainly sell their clothes online and tell people that if you want to return it, you have to come into stores because Primark is pretty much everywhere. And I imagine this works very well with the likes of Next. I've not looked directly into this, but those that have an online presence as well as obviously quite a few stores, they'll do very well. So at the moment, whereas 2 years ago in the pandemic, during these lockdowns, right, it seemed very much skewed to the online retailers. They were in a strong position. They were able to accommodate the high demand. But now, obviously, they're in a weaker spot. They're going to be struggling a bit, in my opinion, because obviously they don't have the infrastructure in place to be able to offer these. Returns in person are a lot more favourable due to the lack of postage and a lot of the tracking that it requires. Plus, you can kind of gauge for it a bit more in person. Okay, I go, oh, what's your problem? You have a bit more of a quality control because you can look at the goods at the time and go, right, okay, look, we're not offering you a refund because you've used and abused it. Or they might go, oh, actually, this is in great condition. Thank you. We'll put this back on the shelf. I don't know how that one rolls. I'm guessing they don't do that. But yeah. Furthermore, let's have a look. So what about, and eBay secondhand clothing are sponsoring Love Island instead of Boohoo? I don't really get why this one's a question because, quite frankly, I could not care less about Love Island. Not something I watch. I don't watch TV at all. Yes, sure, it's very popular amongst all of the sheep that watch TV and sit there and watch Emmerdale and a load of rubbish other than like that. If you're sat there watching Love Island with nothing better to do in your life, you are a fucking nerd. Get out of the house and do something. Like, what are you doing? Sat there watching people online, I mean, this is very relevant, that aren't giving you any sort of value. Oh, wow, yeah, this person likes me. It's like watching a playground. If you want to do that, you're a fucking predator. Get out. All right, look, it's not interesting. It's not at all. So I don't care that eBay, a second-hand clothing, is sponsoring Love Island. For instance, I could say, okay, well, Boohoo Man is sponsored on some of the weightlifting competitions, and you would have seen some world records broken on the Hercules pull or Hercules lift, where they're pulling the 2 pillars by Felix himself, and he's wearing a Boohoo Man shirt. That, I think, resembles a lot more and a more of importance than some crappy online, not even online, some crap show on TV. And then to say you're the main man on YouTube about Boohoo would be good if you go for a bit less basic in your theories. Well, I don't want to be the main man on Boohoo. Boohoo is a brand. I'm an independent person. I'm not just going to be loyal to Boohoo and be the guy that always talks about Boohoo. I talk about Boohoo because it's my largest holding in my portfolio. That's not to say that if the fundamentals deteriorate at a rapid rate, then that's not going to stop me from selling it. I'm no longer that Boohoo guy, am I? So to say that I am the main guy on Boohoo and the one that should always follow it, I have my own agenda. I may end up selling Boohoo at some point if the strategy changes. And I feel that actually they are worse than others in the industry. And now is a good time to let go of that money in that stock and find a better place to put it elsewhere. I'm not the one guy for that. You shouldn't come to my channel expecting me to always have the same light on Boohoo. Opinions change, strategies change. I follow my strategy in which I'm holding one or two companies or a handful of companies that I strongly believe in. But again, if the fundamentals change, I'm not going to believe in it and I'm not going to talk about it. That being said, even if I sold Boohoo, I would likely follow it anyway, not because I'm going to regret selling out, just because I'd be interested in that. But that being said, I'm not selling Boohoo either. But when we jump into the returning online shipping, there are a few points here. They've said that volumes of UK fashion returns are currently 55% higher than they were, let's have a go on the article here, 55% higher than they were at this point in 2021. Furthermore, Boohoo has actually warned that they may start charging for accepting returns, but these are reports, so I don't know where the source is here. They've clearly not linked it, so I'm a little bit disappointed here, but it would be interesting to see. They've also said that Zara will have noticed that it now charges £1.95 for customers to return garments. And if we go down a bit here, actually, it's a very clever thing. And they've talked about the different types of people that return. You have the planned or unethical returner, someone that's going to go, right, I'm going to buy this dress, I'm going to wear it, I'm going to return it, I'm going to exploit the system and return it. Effectively, fraud. You've got the person that is the eager returner, who see it as a good decision, and the reluctant ones that are a bit guilty about returning. Now, you might fall into any of those categories, but I think the best way, and whilst you could charge a fee for all of your returns, I don't think that's the most appropriate decision. Instead, with the data that Boohoo, the data that ASOS have available, if a customer is returning one too many goods, you should start warning them. Say, look, if you're going to do this again, you're going to start being charged for returns, and then putting those charges on those customers with a bad ELO or a bad score, so that then they are obviously less incentivized to buy a bunch of clothes, or they're forced to open multiple accounts to achieve this. Now, if they open multiple accounts to achieve that, then obviously they're bypassing the rule, but it's going to make it a little bit more inconvenient, a little bit more of a pain for them to do that, and therefore it's going to be a little bit better for the business, and they'll maybe get a bit more money back through this. Now, people are saying Boohoo is going bust, for instance, and I'm going to be talking about this next week, so keep an eye for that video, because quite frankly a lot of you are chatting some mad levels of rubbish, and I'm going to absolutely drop that. And they've also said here, on average, all online retailers see 35 to 40% of their clothing sales returned. So those of you that were telling me, oh, so you need to Boohoo are going to go bust for this reason, it's rubbish. It's absolute rubbish. All of them are struggling. It's an industry-wide concern. And in this situation, this person called Marianne Morrison has said that they've had a dress returned soiled and obviously worn, and when they refused a refund, the customer took us to us threatening us to leave a bad review. So you can see how at the moment it's very favourable to that of the customer, but hopefully going forward with that implementation of scoring and of ELO, I think Boohoo themselves could do very well. But again, any retailer that takes on this approach would be very wise, Boohoo being one of the industry leaders. So if they do it, I'm sure others will follow. It'll become like a chain reaction. Once one does it, the rest will. And when we look actually at how well you guys did in the markets this week, it very much seems like a majority of you are down. Now, my portfolio is marginally down, ever so slightly down for the week. I've actually used up all my cash at once this time. So you can see here I have 17,000 shares of Boohoo and 83 shares of Games Workshop. Let's go into a deeper view of my portfolio. And of course, Yahoo Finance is not working. So if this isn't working, that's fine. We'll go and carry on. Right, so basically here, I was down about 54%. Unfortunately, that's not working at the moment. And you can see here the overall figure that I'm down there. And at the moment, yes, my Boohoo position itself is down 60%. I've used all of my cash for this amount because I thought, you know what, I'm going to invest once a month and I'm going to make this one UK stocks I'm buying video, and then I'm going to talk about other topics as time goes on. In this situation, yeah, right, I am down a significant amount, but I'm going to keep averaging in consistent amounts every single month, and I'm just going to buy at the start of the month. Yes, I probably got a bad deal when I purchased these shares of Boohoo, because I purchased them, it's not even going to say here because it's not fully developed yet, but I probably purchased them at the start of the week sometime, let's say, well, let's say probably sometime at like 58 pence a share, and obviously it's down to 56 pence a share. So obviously that is a concern, but at the same time, that's what happens, right? I'm not going to try and time it. Now I can zone out of the markets and not worry that much. So I put about 66% of my deposit into Boohoo and 33% into Games Workshop. I acquired another 3 shares of Games Workshop because I think the PE ratio is quite a valid level, and the dividend yield at that price is quite attractive, and I'd like to just lower my average slightly, and I'd love to get a little bit more income in my portfolio, get a little bit more returns, a little bit more cash flows. I think that'll be effective for the long term. So thank you for watching. Have a fantastic day.